welcome to the first episode of Techonomic, where we break down the economics emerging in AI so that you can do something with it. And we start with a pretty awkward headline, to be honest, one where AI has gone from being, your friendly neighborhood GPT man to kicking down your office door and telling you to get out. That's the last 2 days, $1 trillion in market value gone. And the trigger, Anthropic, the company that makes Claude, released a legal plugin. And they're obviously alongside a bunch of others for customer success, sales and whatnot, but they built this in 10 days. That's 10 days, not 10 months, not 10 quarters, 10 days. Given how much I've slept in the last 10 days, that is literally overnight. Now, let's be fair, like the legal industry is probably the best fall guy that you could make an example out of. It's full of small print and it's notoriously slow. It's perfectly ripe to show off what AI is capable of. But it is another step in the direction of going from asking it a question like Google to ask it to do a task like you. And investors have looked at that and thought, wait, if these guys can automate what lawyers do in a week and a half, what's stopping them from doing the same thing to my industry? And the answer, it turns out, is nothing. Thomson Reuters dropped 60%, LegalZoom dropped 20%, Palantir, which doesn't even do legal software, dropped 12%. So the whole software sector has entered bear market territory. Investment bank Jefferies have called it the SaaSpocalypse, which is the kind of new invented word that makes me want to, go back to hieroglyphics or something. Look, now stock crashes happen, markets react and overreact. That isn't news. What is news is why investors panic, because if you understand that, you'll understand something quite important about what's just changed in the economics of software. And if you run a business or you work for one, a software one, this does affect you directly. So today I want to follow the money. What actually happened to the software business model? Who survives, who doesn't? And what does this mean for the people who work inside these companies? Let's get into it. Part one, what actually happened. Okay, so Anthropic released something called Claude Cowork. It's a plugin that automates contract reviews, compliance workflows, legal briefings. So the kind of work that associate attorneys currently bill $400 an hour for. But here's what spooked the market. This wasn't Anthropic's main business. This was a side hustle, a demonstration basically. So they didn't release just one plugin. They dropped 11: legal, finance, sales, marketing, customer support. Each one of them doing what traditional software companies have spent years building, some decades. And the market has looked at that and said, okay, it's here. So you'll know of a company called Harvey AI. They raised $160 million in December at an $8 billion valuation. And their entire business is built on Anthropic's models. They take Claude, wrap it in a nice interface, add some legal specific features and charge law firms for it. But their supplier just became their competitor. That's not a business challenge. That's an existential problem. So you built your house on someone else's land, and now they want the land back. So Harvey AI now needs to rely on either making it really hard to switch for their customers, having a great brand, or having defensible data or regulatory moats. And this type of need for speed is what investors are freaking out about. The narrative around AI and software just flipped. And investors don't yet know which businesses have the AI literate leaders that will make the right call next. And here's that narrative flip. In 2025, the story was AI helps software companies, better features, faster development, improved margins. So software companies were the AI beneficiaries. And in 2026, the story becoming AI replaces software companies. So same technology, completely different investment thesis. And Reuters puts it bluntly, the software industry, they say, is seen as pretty vulnerable to disruption as tools like Claude increasingly automate the routine and mundane tasks that long underpinned the industry's pricing power. It's a really interesting last couple of words there, the industry's pricing power. And that's the polite version. The impolite version is basically, if your business model is we put a nice interface on top of AI and charge a subscription, you may not have a business model anymore. Now, not everyone agrees with that. There's a guy named Tally Ledger at the Wealth Consulting Group who called the sell-off overdone. And his argument was that improving AI tools should really make it easier to create better software at lower prices, which would improve margins. And that's a reasonable take for some companies. But the question is, which ones? Let's jump into part two. So the economics that just changed. So to understand why this matters, you need to understand something about infrastructure businesses. I know you might have heard people explain AI as being similar to electricity, universal infrastructure that powers everything. And there's something to that, for sure. But here's what's different. Electricity is dumb. It flows through a wire. The power company has got no idea if you're running a toaster or running a factory. They just measure the watts. They can't see your business. AI models see everything. Anthropic knows exactly what people are using Claude for, every query, every workflow, every use case. They can see that legal contract review is pretty high volume. They can see its high value. They can see its high margin, and that companies are charging $500 a month for software that is an interface on their API calls. And obviously they can do the math. So if you're Anthropic and you see that someone's making fat margins by wrapping your product in a UI, the obvious question is, why would you let them keep that margin? And this is not new in tech. Amazon Web Services been doing this for years. Netflix runs on Amazon Web Services. Then Amazon launches Prime Video. Airbnb runs on Amazon Web Services. Then Amazon gets into travel. Retailers run on Amazon Web Services. Amazon undercuts them with their own marketplace. So your infrastructure provider has had perfect visibility into what works and how it works for a while now. They see the traffic patterns, the growth curves, the margins, and they know which applications are worth building before the market does. But what's different with AI, is the speed. Amazon's moves into video and retail took years of planning and billions in investment. This legal plugin Anthropic built took 10 days. And if you're a software company, that kind of should terrify you a little bit, because it means the moat you thought you had, the years of development, the domain expertise, all of that can be replicated in less than 2 weeks. And here's the other thing. I mean, electricity being compared to AI doesn't take into the account that electricity is regulated as a utility. There are rules about what power companies can and can't do. AI is not regulated. There's nothing stopping Anthropic or OpenAI or whoever else from competing with their customers. So they will. So the software value chain used to look like this: foundation models at the bottom, middleware and tools, vertical applications, and then end users. I say used to, I mean in 2025. And each layer in that scenario captures margin. Now the foundation model companies can collapse that stack whenever they want. They can skip the middleware, skip the vertical applications, and just go straight to the user. Not for everything, but for anything that's high volume, standardized, mundane, margin rich. They're definitely coming for that. So what does this mean for you if you're a business leader? If you're buying software, your leverage just increased dramatically. The vendors who are charging you $50 a seat a month, probably suddenly a lot more negotiable because they're probably scared. If you're a large enterprise, you now have a real option to build instead of buy your tools. Generative AI makes it possible to create prototypes, to create internal tools that are tailored to your specific workflows. And actually, a lot of enterprises are starting to do exactly that: build instead of buy. And if you're selling software, you need to figure out really quickly whether your product is defensible or whether it's a feature that ChatGPT could replicate in a sprint. Okay, part 3, who survives and who doesn't. So let's talk about what this means for software companies specifically, because not everyone dies here. Some companies are actually going to do pretty well. There's a report from Vedantics on enterprise survival strategies in software, and they're pretty blunt about it. They say horizontal point solutions are finished. So what does that mean in plain English? It means that if your software does one generic thing that lots of companies need, like we help you manage contracts or we help you send emails, you're in trouble, because that's exactly the kind of thing an AI agent can do, or that can be built internally rather than bought. You don't have a defensible business in that scenario, and you may need to consider what you do next because features get absorbed. So what is the solution to that? What survives? Vertical specialists with data moats. What does that mean in plain English? So the translation of that is basically companies that have spent years and years and years accumulating really specific industry data that just can't be easily replicated. So think, healthcare software is deeply integrated with hospital systems and has 15 years of patient outcome data. Think about financial software that's embedded in trading workflows with real-time market data feeds. Manufacturing software that's connected to factory floor equipment. Your competitive advantage is no longer the AI model. Anthropic, OpenAI, and Google will give anyone a capable model now. The advantage is the unique data you've accumulated, the end-to-end workflows you own, and the switching costs you've embedded in your integrations. So basically, if ripping out your software would cost the customers 6 months of work and $2 million, you're probably okay. But if they could switch to Claude co-working in an afternoon, you're probably not. And so what this means if you're running a software company is verticalized, prepared to be acquired. And that's what the Verdantix report recommends. So if you're mid-market, you either need to go deep into a specific industry or you need to find a buyer while you still have leverage. And the enterprise software M&A market is projected to go gangbusters in 2026, 600 billion, and that's up 30 to 40% from last year, whilst business valuations in the software space are compressing by up to 30%. So if you're an acquirer with cash in the software space, good buying opportunity. And if you're a potential target, good time to evaluate your options and while you assess your next steps. And what this means, if you're a large enterprise, it means that the build versus buy calculus just flipped on its head. Previously, it almost always made sense to buy software. Building was expensive, it was slow, and required really specialized talent that you just didn't have. If you're a media company, you were not a tech company. Now, Gen AI makes it possible to build internal tools a lot faster, a lot cheaper. And a lot of these large enterprises are looking at their software stack and they're thinking, why are we paying these vendors when we could just build this ourselves? And McKinsey's research says this exactly. Gen AI's capabilities allow enterprise customers to build rather than buy more software, which represents a significant shift in value pools and in competitive dynamics. So if you're a large enterprise, you should be investigating internal AI development capabilities and developing AI literate leaders across the board. You know, data platforms, model fine-tuning, prompt engineering teams, these should all exist in an enterprise now because the option to build just got pretty attractive. All right, part 4, what happens to the people? Okay, let's talk about jobs, because when the software economics are going to change, headcount follows, or should I say headcount starts. Goldman Sachs is estimating that AI could affect 300 million full-time jobs globally by 2030. That's a big number. I see a lot of zeros here. It's also a global number that doesn't really tell you about much or about what happens to specific people in specific roles. So let's give you the specific picture here. In the first 11 months of 2025, there were 55,000 layoffs directly tied to AI by some reports. That's a 400% increase from the previous year, while entry-level employment dropped 13%. So you can see that pattern dovetailing and emerging there in the legal profession, for example, which Anthropic just targeted, is looking at associate attorney roles that do that task. And they're asking, do we need as many of these? So the pattern is pretty consistent. Junior roles are going first. That's what's happening around the country, around the world, in large businesses. McKinsey is running actually an experiment on itself right now. They're growing client-facing roles by 25%, and cutting non-client-facing roles by 25%. So that same workforce is being moved from back-end, mundane, repetitive work to front-end, client-facing, strategic work. Same total headcount, just completely different composition. They currently employ 40,000 humans and 25,000 AI agents, and they expect that to sort of be equal by the end of 2026. And we see that with Amazon cutting 16,000 roles, Salesforce eliminating 4,000 support roles. So the workforce is shrinking, but it is also, more importantly, shape-shifting. The question here is whether you're on the right side of the shapeshift or on the wrong side of the shapeshift, and you can control that too. But here's the timeline as the research sees it. 2026 is the pilot phase for that, of who gets replaced, what gets replaced, and whether companies choose to replace people or workflows. Those are the broad 2 choices to make, but they have significant consequences, whichever one you pick. And so 2026 being the pilot phase, where it's predicted that around 37% of large firms will deploy agentic AI, but around 14% of junior roles in exposed sectors get displaced. 2027 onwards is widespread adoption. 40% of enterprise applications, not enterprises, but applications, will embed agents. And this is when peak displacement takes place, with the idea that by 2028, agents are absorbing not just a task, not just a workflow, not just a junior, but divisions. So this is all scary stuff, right? But we can navigate it. Now, what this means for you as a business leader is you need to think about workforce composition, not just headcount. So that McKinsey model I talked about is kind of instructive. Grow strategic roles, shrink routine roles, and end up with roughly the same amount of people doing completely different work. And if you get it right and you level up each staff member, it isn't as much about cost cutting or replacement. It's about portfolio rebalancing. And the companies that handle that well are going to restructure proactively. And the ones that don't will do it because they're forced to in panic layoffs, followed by panic hiring when they cut the wrong people or realize they cut the wrong people. And what this means for you as an individual, and the research is pretty clear on this one, the combination of your deep domain expertise plus AI literacy is what wins. So if you're an expert in your field and you know how to use AI to amplify your work, you become dramatically more valuable. AI skilled workers are already commanding 25 to 56% salary premiums. And if you don't have domain expertise and you're using AI to fill knowledge gaps, ask questions, and basically train AI rather than have it train you, you're in a more precarious position because you're the one competing with AI in a year's time. So the people that will thrive headcount-wise are the ones who have that genuine domain expertise and known for something, and also know how to make AI accelerate it and not outsource it. So, chapter 5, what to do about it. Practical time, what should you actually do? So here are my hot takes from working in the field, right? If you're a large enterprise, move from pilots to production. Gartner reckons around 80% of enterprises will have generative AI in production by year end, but only 1% consider themselves AI mature right now. And what does AI mature mean? It means that the people making the decisions are not ready to make those decisions. AI maturity right now is a very people-based topic, and that is where the competition is happening, and that's where the gap is widening. And so that's a really, really important piece. And you'd also, if you're a really big business, want to restructure workforce composition, like we've talked about, grow strategic roles, shrink routine roles, and invest in AI development. 95% of workers want AI skills, and only 5% of organizations are actually teaching them. They're giving them this amazing technology and not teaching them how to use it. That's a surefire way to have it train or replace that staff member, really. And if you're a mid-market software company, it's about verticalization and depending on defensible territory. So do you have industry-specific data? Do you have regulatory complexity? Do you own the workflow? And is it a high switching cost? Otherwise, prepare for mergers and acquisitions. And if you're a small company, this is one of the best times, or I honestly say this to some of my friends, in 10 years' time, small companies will look back on this and wonder why they didn't move faster. So exploit your agility. You can move faster than large enterprises that are stuck in compliance. But that window is temporary. And you can see that, like I've said, Anthropic and OpenAI, they'll go for the easy wins with high margins within year end. So it's now is the time really for small companies to use their agility. And to close out, if you're an individual, develop that domain expertise, become known for it, become genuinely good at it, and then use AI to organize and amplify it yourself. And the people who win in that environment are not the ones who know the most about AI. They're just the ones who know how to use it the best, organize their thoughts, structure their outputs. So to conclude, the SaaSpocalypse. $1 trillion has disappeared because investors basically realize that foundation model companies can build software companies or applications faster than software companies can build them. And that changes the economics of software. Horizontal point solutions are a bit vulnerable. Vertical specialists with data moats will survive, and the build versus buy calculus flips for enterprises. You're likelier to see more benefits in building rather than just buying software. The workforce obviously follows the economics, and junior roles will get hit first. The senior roles that require judgment and creativity are going to grow, and so the shape of all these companies are going to change whilst the task structures changed as well. So, with all that said, everyone's going to have a bumpy, rocky, interesting, and probably slightly turbulent couple of years. And that is just where we are. But the more you know, the more you know. And that's what Techonomic is here for. So thank you so much for listening. And next time we'll look in a little bit deeper at some of these hybrid monetization strategies that are emerging in AI. I'm Krish, and I'll see you next time.